Do you want to invest your money but you don't have the time to do so? Or maybe you just don't know where to start. Maybe you would prefer an experienced professional to manage your investments for you. Today we'll be talking about mutual funds and how they can help you grow your money without you needing to be actively involved. So before I start, this is not financial advice. I'm not a professional. This is for entertainment purposes only. You get the disclaimer. Let's move on. First things first, what is a mutual fund? Really simple, a mutual fund is just a company that's going to pool money from many investors like yourself, and they're going to invest that money, depending on the type of fund, into stocks, bonds, commodities, etc., etc. Into mutual fund acts like a company. We could buy shares into the mutual fund and it will act just like a share in the stock market, and we'll have part ownership in that fund. So as the fund grows and they start to make money, we get a small little sliver of that profit depending on our size. Okay, cool. We understand what a mutual fund is. We understand what it does. We understand that it acts just like a company, right? Okay, but who is the mutual fund for? The beauty of a mutual fund is that it's for anyone and everyone that wants to participate in it. Rich, poor, middle class, whatever you want to define yourself as. And this all goes back to the purpose of a mutual fund, right? We want to outsource all that management of our investments to somebody else or to a group of individuals who are a lot more experienced and have a lot more time to do research on all these stocks, right? You know, it could be a fairly passive way if we choose the right fund where we don't have to research tens, maybe even hundreds of different stocks and divest and invest and do all these crazy calculations and analysis on the market and figure out where we're going to go next and blah, blah, blah. See, even everything I just said is a mouthful, right? But that's actually what you have to do. That's actually what these people are doing. So imagine doing that and still having to take care of everything else in your life. Now, I don't like saying anything is impossible, but that's a hefty task right there. And you might say, Novato, come on, 100 stocks, really? That's a little exaggeration. And it might be a little bit hyperbolic. But let's say even tens of stocks or 10 stocks. That's still a lot for you to manage alone. I'd much rather have somebody else deal with that so I have more time to do other things. You know, we would all like to think that we could do it ourselves and DIY this and DIY that. But the reality of it is, you need people. In order to be successful, you need people. And that's something that I'm learning over time. If you look at some of the most successful people in the world, or anybody that's successful, they have a team around them. They have a support group. You look at these musicians and these athletes and everything like that. They have a team behind them, multiple teams if that. Another thing is these funds offer a high level of diversification that you would not be able to get yourself, or like I said, it would be very, very difficult for you to do that. And I know earlier when I said 100 stocks and it could have been a little bit hyperbolic, but really that's how big some of these funds are. So imagine just purchasing one thing to get exposure into a whole bunch of different baskets, to be able to put your eggs in all of these different baskets. Crazy idea. And you might think something like this is going to cost you an arm and a leg, maybe a shoulder, maybe even your chest, but it's really affordable again to these funds, like really affordable, like really affordable. And you could put down as much as you want. And most of these funds don't have a minimum. When I say minimum, what I mean is you could put $5 down to some of them, you could put $5,000 down. It really depends how much you want to risk, how much you want to invest at that very moment in time. And you can continue to build up your number of shares or your ownership in that company as time goes. Going back to the whole diversification of mutual funds, there are various types of funds that you can get into. Now, typically we could break them up into 4 different categories: bond funds, money market funds, stock funds, and your target date funds. Now, money market funds are going to be your lowest level of risk type of fund, right? The reason for that is by law, they're required to only invest in high quality investments that are issued by US corporations, local, state, and federal governments. Like I said, this is probably one of your safest bets, if not the safest bets when it comes to mutual funds, but not as much reward. We always follow that principle: low risk, low reward. And the next step up on that ladder are bond funds. Now, bond funds have similar to money market funds, but they have a little less restrictions, and therefore they're a little bit more risky. Stock funds, as you can guess, invest in stocks, in corporate stocks. Those would be like your Apples, your Amazons, your McDonald's, etc., etc. And evidently, not all stock funds are the same. We have subtypes of the types. Again, we could break these stock funds into 4 different categories. Now we have growth stock funds, which are going to focus on trying to beat the market, gain you those above average gains, but maybe they're not going to give you such a good dividend. On the opposite side, we have income stock funds, which focus on stocks that pay a regular dividend. See, these kind of stock funds are good if you want to focus on holding long term and getting rewarded for holding long term, in addition to the stock price potentially most likely increasing over time. Income stock funds are most likely going to be invested in those dividend aristocrat stocks. And dividend aristocrat stocks are stocks that have paid and increased their dividends consecutively for the past 25 years. So you have a long history. longer than I've been alive. The next fund we have are sector funds. Now, sector funds are made to invest in a specific industry or an industry segment. That could be your tech stocks, that could be your healthcare stocks, that could be your energy stocks, etc., etc. So if you're interested in like thinking Tesla will be the future, right, or electric cars will be the future, you invest in a fund that mimics that's their objective. And the last type of stock fund we have are index stock funds. Simply, these funds try to track a specific index such as the S&P 500 or the Dow, etc., etc. Now that was just stock funds. The last type of fund that we have are target date funds. And this is just simply a mix of all types of investments, stocks, bonds, etc., etc. But you typically see these in these 401k plans. These types of funds will be good for individuals who have a retirement date in mind. You know, you'll usually see something like blah, blah, blah 2040 fund or blah, blah, blah 2050 fund, right? Because they have that retirement date of 2040, 2050, etc., etc. Okay, not just for telling you all the great things about these mutual funds, but there has to be a downside. Before we get into the downsides, if you're getting some value from this video, hit the like button and don't forget to subscribe. You see, the risk with the mutual fund is going to be pretty much the same risk as if you were in the stock market, right? Because like I said, these funds behave like a stock. They are built up of stocks, bonds, and other types of investments. So you know the typical, you could lose all your money, you can go to zero, be included in that, but we could always minimize our risk by doing our research. We could look at a firm's past performance or a manager within that firm's past performance to make a more informed decision and minimize the risk. Generally, the more stable a fund is, the more secure the investment is, therefore the more trust that we could put into that, and that trust is going to be in the form of money. Now, I would not be doing a good job if I did not tell you about this. One of the major costs that comes with these mutual funds are fees. They had to get us somewhere, didn't they? Well, this is to be expected. Like any other company, it's going to take money to run it. You got to pay for portfolio management, administration, marketing, distribution, office space, everything like that. And the funds just pass these costs off to you, the investor. Now, these fees could really eat into your profits depending on how high they are, and they vary from fund to fund, of course. And this is where we go back to laying down that groundwork of doing some research to make sure we pick a fund that has a good mix of investments, consistent returns, and a low expense ratio. Now, hold up, you just hit me with a whole new word. What's an expense ratio? Well, the expense ratio are those fees that I was talking about. But instead of just giving you a dollar amount, they represent it as a percentage. So for simplicity's sake, this is a tad bit high, but let's say a fund had an expense ratio of 1%. What that means is for every $100 that we invest, they're going to take $1. For every 1,000, they're going to take 10. And so on and so on and so on. Now, like I said, these fees will eat into our profits a bit. So it's important that we pick a fund that has a relatively low expense ratio for us to invest in. And for help with choosing the right fund, check out this video where I go through the process of selecting and purchasing a fund.